All right. Good day, everyone. Today we are going to be dissecting business valuation. There are two aspects that we are going to consider. Uh, the second one, we are going to do it once we are done with valuation. So, merger and acquisition is part of the scope of your strategic financial management, and then it's purely theoretical. There is nothing like calculation in merger and acquisition. The major work is in business valuation. So my intention today is to take my time to explain all the underlying concepts in business valuation. So once we are done with everything that has to do with valuation, we can spend like maybe 2 hours or less to explain the theoretical aspect of merger and acquisition. All right, there is nothing like calculation there. And then that's one of the reasons why I don't want to, uh, I want to use this working note to be able to show you, to demonstrate step by step what you need to do under each methods of valuation. All right. Uh, the valuation exercise will take us for the next 2 to 3 periods. All right. It will take us for the next 2 to 3 periods, all things being equal. Um, is a lot. And as you know, based on your experience so far under this subject, strategic financial management, valuation is, is the most frequently tested topic in ICAN exam. There is no single diet. For the past 20 years, there is no single diet that ICAN will not test valuation. And that's to show you is the most frequent and is the most uh, important as far as valuation, as far as the ICAN SFM exam is concerned. If it doesn't come out as a compulsory question, then ICAN will test it either section B or in section C. Mostly it will be a compulsory question. All right. So, but valuation question can be tricky depending on depending on the knowledge that you have on the subject, on the topic. So if you're able to digest all the underlying concept of valuation, how to value each, how to value a business or a segment of a business, all right, or even a company's assets, and you know how to each method that you can use to value a business, no matter how the examiner scatter the question, no matter how voluminous is the question, if you follow the concept, certainly you get to the right answer. All right. Even if you are not, if you don't have the high answer 100%, you are going to be very close to getting it 100%. What the examiner is expecting you to do is to show me, demonstrate that you have the knowledge, demonstrate that you have the skill for you to be able to, if you find yourself in the future, if you find yourself in a company or in a firm whereby you are expected to, you are required to carry out valuation analysis, how do you do this? All right. So what we are doing are purely theoretical as well as the practical, as well how you should do it in practice and all of that. I will bring to bear some practical approach to valuation as we proceed. All right. So let the class begin. What do you understand by valuation? Now, first thing first, our focus under this topic will be the introduction. Okay, introduction to valuation. Then we are going to talk about reasons or purpose of valuation. Reasons for valuation. Then after that, we now begin to dissect the methods of valuation. Okay. So once we are done with the explanation of the methods, then we can begin to have illustration. Okay. If today we have illustration, so be it. But my target today is to explain the concepts. All right. If you still have time that can accommodate any question, then we go ahead. That will relieve our stress going forward. Now, what do you mean by valuation? Valuation represents the process of determining the economic worth of a business or of a company's shares. When you want to determine the worth of a company or the worth of a company's shares, like for example, equity value, you want to determine equity value. The process of doing that is what we know as valuation. And there are different methods, there are different reasons for valuing a business or for determining the value of a company's shares. There are different reasons. One of the purpose of valuation is for merger and acquisition. When two businesses are coming together to become one, or when a company is acquiring controlling interest in another entity, right, there will be need to value, to know the worth of the individual company. Let's say, for example, in a merger transaction, for example, company A we need to value itself, company B will also value itself, so that we want to know before we come together, how much do I want? All right. By the time you come together, it will become a combined entity. So when there are merger and acquisition transaction, then we carried out valuation of the margin entities. Another method, another reasons for valuation is for estate and tax purposes. All right. So for estate and tax purposes, when a deceased left an estate behind, okay, so it is important that the administrator or whoever that will be the beneficiary of the estate, they need to pay tax from the estate, from the profit made from the estate to the government. Therefore, you need to know what is the value of the entire estate. Not only that, for the purpose of even sharing the estate among the beneficiaries, you need to know the value or the worth of the estate. All right. Another reasons for valuation is when there is litigation. Litigation can arise between the principal and the agents. It can arise between a company and a contractor. All right. When there is a litigation, the courts may decide that they should determine the value of the company or of the asset in dispute for the purpose of determining the claim to be paid to either of the parties. All right. Not only that, we also carry out valuation for the purpose of stock exchange listing. When a company wants to go for initial public offer, for example, you need to know the worth of the business. Again, a company may want to borrow loan from the bank. All right. So depending on the size of the loan, if it's a very huge amount of money, then your bank or your investor may want to see that I want to see your worth that will be able to support the loan that you want to borrow. Again, there are several reasons for valuation. These are just few of them. I can list, I think in your material you have about 7 or 8 of them there, but just for you to have idea. I doubt if examiner can be asking you to state the reasons for valuation. Now, we are moving to the next item. The next one is to discuss methods of valuation. There are several methods of valuing a company or a company's share. However, we are going to categorize some of the methods into 3, and we then begin to explain each of them. All right. So The first method of valuing a business, let me put it down for you. Methods of valuation. Okay, so like I said, there are three methods. The first one is asset-based approach. Okay, asset-based approach. The second method is income-based approach. Then three is discounted cash flow. Discounted cash flow based approach. All right. So on the day of your exam, any of these will come out. All right. You have to know what to do under each of them. So let's talk about asset-based approach. All right. Asset-based approach. Now, this is a method of valuation that relies on net assets in the valuation of a business. Okay? This, let me put it down for you. This is a method of valuation that uses net assets. That uses net assets for valuing a business. Okay? For this purpose, net assets represent total tangible assets minus total liability. Net assets represents total tangible assets I said net asset represent the difference. Did not put difference. Represents the difference between total tangible assets okay, and total liability. All right. So that gives you the net assets. So what we are trying to say is that anytime you want to value a business and you have to use asset-based approach, just calculate net assets. Net asset is the value of the business. All right. So if you are not asked, like I said, value, the value of a business is equal to net assets. Okay. And you know that net asset is total tangible assets minus total liability. So that will give you the value of the business. So if you now want to determine value per share, if you want to determine value per share, okay, value per share will then be calculated as net assets divided by number of shares, number of ordinary shares. So that's what you need to do. It's very straightforward. Asset-based approach does not have any ambiguity. It's always very straightforward. But one thing you need to understand is that when you are using asset-based approach for valuation, you only consider tangible assets, which means that any intangible asset like copyrights, goodwill, okay, patent rights, are ignored. You don't use intangible assets for valuation using asset-based approach, except there is market value for them. If you are given market value of the goodwill, if you are given market value of patent rights or copyright, then you need to include it as part of the asset. But if you don't have market value for the intangible asset, you have to ignore it. You don't include intangible assets as part of your assets when you are calculating the value, when you are determining the value of a business using asset-based approach. Okay? Note. Let me put it down for you. Note. Intangible assets. Intangible assets, including goodwill, copyrights, patent rights, etc. should not be included. Should not be included when determining net assets, except they have market value. Except they have market value. Okay, so please, anytime you want to value a business and you are given intangible assets using asset-based approach, you don't include intangible assets. And I've also told you examples of intangible assets to include goodwill, patent rights, as well as uh, copyrights. Those are some of the examples of intangible. When you say tangible assets are those assets that are movable. You can see it, you can touch it, like building, like motor vehicle, like plants and equipment. You can touch it, you can move it around. Those are tangible. Intangible are those assets that you cannot see, you cannot move them around. All right. So, and that's why we are saying here that when you want to value a business using the asset-based approach, all intangible assets should be ignored except they have a market value. Okay, now there are different types of asset-based approach. Okay, there are different types of asset-based approach, types or forms of asset-based approach. All right, types or forms of asset-based approach. All right. We have book value. We have book value. One is book value. Two, we have realizable value. This is basis. Realizable value. Okay, value basis. Then three, we have liquidation basis. We have liquidation or breakup basis. Then four, we have replacements value basis. All these bases of valuation under asset-based approach they are going to value the business the same way. That is, under each of these four, the same thing you are going to do. Simply calculate net assets. All right, simply calculate net asset. That's what you need to do. Total tangible assets minus total liability will give it a net assets. But the difference between each of them is that for the book value, using the book value, it means that you are using the value as shown in the balance sheet in the statement of financial position. Any value that you have in your statement of financial position are your book value. So you are using what you have in your balance sheet to value the business. So to do that, just take the total tangible assets, then you less total liability. It will give you the net assets. To use the realizable value basis is the same thing. The realizable value, liquidation basis, replacement value basis is the same thing you are going to calculate. But the only thing is that you are going to replace the book value you have in the balance sheet. Instead of using the book value, you are going to use realizable value, or you use break-off basis value, or you use replacement value. All right. So let's say for example, for an asset, for motor vehicle, that worth in the balance sheet, this motor vehicle is worth 10,000 naira, right? Then let's say, for example, the company now liquidates. For the purpose, when the company liquidates, when the going concern of the company is being threatened, and there is no the company does not have the capacity to carry on a going concern basis, that means they need to realize the asset of the company. They need to dispose of the asset of the company. So before they dispose of the asset of the company, they want to know what is the value of those assets, so that they'll be able to get the true amount of money, or a reasonable amount of money from disposal. All right. So doing this, let's say, for example, at disposal, they now realize 7,000 naira, for example. So if I'm using the breakup basis to value the business, instead of me to use 10,000 naira, which represent the cost of the book value of the motor vehicle. So instead of me to use 10,000, I will replace it with the 7,000 breakup basis. So the liquidation value of 7,000. So that's what you need to do. All of them is the same net asset that you are going to calculate, except that for realizable value, liquidation value, replacement value. So you will replace you replace the figures in the balance sheet with the figures given to you under each of them. So that's basically what you need to do for asset-based approach. And again, is there any technicality in this on the day of your exam? It's always very straightforward. And ICAN do tests more often. They do test asset-based approach more often. In recent time, examiner can ask you to use asset-based approach. You may be asked to use a price-earning ratio to value the business. You may be asked to also use a cash flow basis. So you need to know what to do. But again, like I said, asset-based approach is the simplest of all the methods of valuing a business. Okay, so when you go to your material, to your study material, you can gain more insights on what is book value, what is realizable value, liquidation. I have it. I've given it to is in your notes already. All right. So let's move to okay, just for concepts, for more insights. Let's say, for example, you want to, before I move to the next method, so let me just give you this format. Let's say, for example, we want to value a business using asset-based approach. So this is what you are supposed to do. In fact, if you are given the four of them in a question, you have book value, you have assets, you have a realizable value, you have liquidation value, and then replacement value in a question, and you're asked to value the business. So you can even match all of them in a table. Yes, you can match all of them in a table. Say, for example, I can come here to say book value, right? I can have, after book value, we can have realizable value. So it's not compulsory that you are going to have the four of them in a question. So whichever one that you have, just go ahead and calculate it. Then we can have replacements, value. Then we can have a breakup or liquidation, value. All right. So this is the format. Whenever you want to calculate, you want to value a business using asset-based approach. As you know, asset-based approach, we only provide a guide, a minimum guide for the value of the business. So it will show you you can't use asset-based approach as a standalone method of valuation. You have to use it in conjunction with other techniques of valuation. So let's say, for example, we have um, non-current assets such as a motor vehicle. Okay, let's say we have motor vehicle. So in the book value, let's say you are given value in the balance sheet, you have motor vehicle. So you put the amount there. You then go to the question, what is the realizable value given to you for motor vehicle? Whatever it is, put it there. It's not all the assets the examiner will give you value for. So anyone that you are not given the value, then you use the book value. Okay? Now, let's say again we have plant and equipment. Plant and equipment or plant and machinery. So whatever it is, put it there. They are tangible. Then let's say you have a properties. All right? Put it there. So there is no need for any categorization to say non-current assets or current assets. No need all of those. Just add up all the assets together. Then let's say, for example, we have inventories. Okay, add it to it. It's part of your assets. Then, if you have receivables. Okay, add it. If you have any cash, it's part of assets. Cash and cash equivalents, or cash and bank balance. So whatever it is, put it down. You then add up all the assets. You add up all the assets. This will give you total tangible assets. Then you now less liabilities. All the liabilities given to you. The current liability and the non-current liability, just deduct it. Whatever you have thereafter will now give you the net assets. Okay, so this is the net assets, which means the value of this company under the book value is what you have here. That's the total value. The value of the company under the realizable value is whatever you have here, and for all of them. If you now want to determine value per share, you need to divide the net assets with the number of shares. So that will give you the value per share. All right. So that's what you need to do. Now, like I said, the asset-based approach is just a minimum, or is designed to provide a minimum guide for the value of the business. So the asset-based approach should be used in conjunction with other methods of valuation, like a discounted cash flow method. All right. So that's that. Let's move on to income-based approach. Okay. Now, under the income-based approach, there are three components that make up the income-based approach. One is price earning ratio, price earning ratio. Let me write it out in full. All right. Then two, we have discounted or dividend, discounted dividend model, or you call it dividend yield. Dividend yield basis. You can also call it discounted dividend model. Then three, we have earnings yield. Earnings yield basis. So these are the three components that make up the income-based approach. So let's take it one by one. What do you do? What is price earning ratio? How do you use price earning ratio to value a business? What are the things that you need to take into consideration using price earning ratio? So we are going to discuss that. For the dividend yield, what do you mean by dividend yield? How do you use dividend yield to value a business? We also discuss it. Then the last one is any yield. What is any yield? What is the market value of a business using any yield? How do you calculate the value using any yields? So let's quickly, within the next few minutes, discuss this. Let's talk about price earning ratio. Okay, price earning ratio. What do you mean by price earning ratio? The price earning ratio represents the ratio of share price. It represents the ratio of share price to earnings per share. Okay? Price earning ratio represents the ratio of share price to earnings per share. Valuation. Let me put it down. Price earning ratio represents the ratio of share price to earnings per share. I don't know if you have done, I don't know if you have done um, financial statement analysis. You would have been told how to calculate price earning ratio under the investors or shareholders ratio. So I think when we had cost of capital, specifically when we did a project specific cost of capital, we did something like this. And I told you that price earning ratio, PER, price earning ratio is calculated as share price divided by earnings per share. So this is the formula to calculate the PE ratio. You want to know how many times does the market price cover the earnings per share? How many times it measures the frequency of time that the share price cover the earnings per share. All right, the higher, the better. Okay. Now, when you look at this formula, the numerator, which is share price, is the value of the business per share. This value of the business, if it's a quoted company, if it's a listed company, the company that is listed on stock exchange, you can always see the market value there because the market value is publicly, the value or the price is publicly quoted. You can see the value when you go to the to the stock exchange. You can always see this value. All right. When you go to the market, I mean, the price is there in the market. So you can always know. For example, if you go to Nigerian exchange, all those companies that are listed, you can see the market price of their shares. You can see it there because it's a public company. It's only a limited liability company that you cannot see their share price. Okay. So today now, if I want to value, for example, Guarantee Trust Bank, all right, all I need to do, and I'll pick some, okay, don't let me digress. Don't let me digress. When I get to where I'm supposed to mention some practical approach to valuation, I can talk about that. But for now, let's go straight. So this numerator, which is the share price, is the value that you want to determine. Therefore, if I now want to calculate the market value, when I want to calculate the market value of the company's share or of the company itself, then it will be share price. It will be price earning ratio multiplied by earnings per share. So just cross multiply. So in this case, value per share would then be the earnings, will be the price earning ratio multiplied by earnings per share. Okay. But if I want to determine total market value of the business, it will be price earning ratio multiplied by earnings. Okay. So let's continue. Please, if you want to ask me any question, always raise your hand so that will allow you to talk. So this is just, I said price earning ratio is the ratio of share price to earnings per share. Therefore, to now determine the value of the business, so I would then say the value of a business, the value of a company, the value of a business using price earning ratio is determined or is the price earning ratio. Okay, let me put it this way. Let me write this one. The value of a business using price earning ratio is calculated as price earning ratio multiplied by, what's wrong with you? Multiplied by earnings. Okay. Now, pay attention, please. When you are valuing a business using the price earning ratio, you can only do this for a company. Price earning ratio is mostly suitable for companies that has a profitable history. A loss-making company or a loss-making entity cannot use price earning ratio to value itself. All right. You only use price earning ratio for valuation if the company has a profitable history. If it's a kind of company that makes profits almost on a yearly basis, then you can use price earning ratio. And price earning ratio can be used to value any business, whether a quoted company or an unquoted company. But the challenge is that unquoted company does not have price earning ratio. So what that means is that you need to get the price earning ratio of a comparable company operating in the same industry to value an unquoted company. I will still write it down. I just want to explain it to you. However, as a quoted company or a listed company is less risky relative to an unquoted company. Let's say, for example, in the banking industry, right? Let's say Zenith Bank is quoted on Nigeria Stock Exchange, but UBA or Access Bank or GTB or any other bank is not quoted on stock exchange. You can see all the banks, they are comparable. All the banks that I mentioned, the Zenith Bank, Access Bank, UBA, GTB, they are comparable company. They are company of similar sizes, all right? But because of the fact that if I now want to value Access Bank, for example, since Access Bank is not quoted on stock exchange, I need to borrow the price earning ratio of Zenith Bank that is quoted. So the company that is quoted on stock exchange is less risky relative to an unquoted company because Zenith Bank is quoted. The risk associated with Zenith Bank is lower relative to, let's say, for example, Access Bank, right? So if I now want to value Access Bank, I cannot use the same price earning ratio for Zenith Bank that is quoted. I can't use it for Access Bank that is not quoted. Because when I do that, it means that I'm assuming that both the quoted company and unquoted company have similar business risk, which is not true. Because as a quoted company, you are less risky to a company that is not quoted. Therefore, what are you supposed to do? Using price earning ratio to value an unquoted company, you are supposed to adjust the price earning ratio of a quoted company downwardly between the ratio of 10 to 50 to account for the risk inherent in an unquoted company. Because an unquoted company is risky or is more risky relative to an unquoted company. So and that's why you have to adjust for the risk inherent in an unquoted company. So you don't use the price earning ratio of a quoted company directly for an unquoted company. When you do that, you are assuming that they have the same risk, which is not true. And that's why the rule says that you can adjust for between 10 and 50%. So the percentage of your adjustment will depend on your perceived risk. If the company is perceived to be highly risky, then the percentage will be high. If the unquoted company is perceived to be relatively risky, then the percentage will also be low. So it all depends. You just have to adjust for the risk associated. You have to adjust the price earning ratio of a quoted company downwardly. All right. So let me put it down for you. Yes, Ruth Ogundola, please mute. Your speaker is on. Ruth, thank you. So the price earning ratio, let me put it down for you. The price earning ratio is mostly suitable. Okay, it's mostly suitable for companies that have profitable history. Okay, this means that any company, or this means that a loss-making company, a loss-making company cannot use PE ratio for valuation. Okay. Now, like I said, when you value a business, and let me put it this way, the PE ratio can be used by both quoted and unquoted companies. Okay. However, I'll put it this way. However, since the PE ratio of an unquoted company of an unlisted company is not available in the market. It's not available in the market, or it's not available publicly. The PE ratio, the PE ratio of a comparable listed company can be used to value an unquoted company. Okay. When this happens, or when valuing an unquoted company, when valuing an unquoted company, using PE ratio, the PE ratio of the quoted company of the listed company should be adjusted downwardly to account for the risk inherent in an unquoted company. Okay? Between the ratio should be adjusted downwardly between the ratio, let me write this. Should be adjusted downwardly between the ratio of 10% and 50% to account for the risk inherent in an unquoted company. Okay? So the percentage of adjustments, or the percentage to use between 10 and 50% will depend on the perceived risk. Will depend on the perceived risk associated with the unquoted company. So what we are saying here in essence is that for every student on that day writing the exam, right? For every student in the exam hall writing the exam, you cannot have the same answer using the price earning ratio method. You cannot have the same answer because you may believe that, okay, because examiner may not tell you to adjust for the risk inherent in an unquoted company. So I may decide to use 15%. Another student can use 30%. Another student can use 12%. So whatever you think is the perceived risk is what you are going to calculate for. So let's say, for example, a quoted company has a PE ratio, right? A quoted company has a PE ratio of 10. And I want to value an unquoted company. An unquoted company does not have PE ratio because its share is not publicly traded. Therefore, I need to look for a comparable company that is traded on stock exchange. So, and we have found a company with a PE ratio of 10. So if I now want to value this unquoted company, I cannot use 10 directly as my PE ratio. I need to adjust for the risk because an unquoted company is risky because it's not traded on stock exchange. Therefore, I can decide to use, I would then say the PE ratio, adjusted PE ratio would then be equal to, if I decide to say, okay, 15% is the risk associated with this unquoted company, I will just say 10 multiplied by 85%. That is 100 minus 15%. So I would then use 8.5 as my PE ratio for an unquoted company. If I think that, okay, the risk associated with this unquoted company is 20%, that means I will only account for 80%. If the risk associated with an unquoted company is 35%, that means I'm supposed to account for only 65% of the PE ratio. So this is what you need to do. Examiner may not tell you on that day to adjust for your for the risk, to adjust your price earning ratio. It is implied that you know what you are doing. In fact, there are some instances whereby even in ICAN Pathfinder questions, all right, in a particular diet, ICAN did not adjust it for valuing an unquoted company, which is not true. It is not true. You can't just use the price earning ratio of a quoted company for an unquoted company without adjusting for the risk. That's not appropriate. That's not the right thing to do. But again, it's an exam question. It's what it is. But that doesn't mean the calculation is correct. All right? So, but what you should do at the end of the day, after you are valuing the business, you are supposed to state your assumption, right? Whatever the assumption that you have made, you have to state it. How do you do this? Just go ahead and say that, okay, XYZ Limited is an unquoted company and does not have a PE ratio. Therefore, the PE ratio of the quoted company XYZ has been adjusted by 15% in order to account for the risk inherent in the ABC Limited. So you just have to state your, so that you make examiner understand your position. That's all you need to do. So finally, to value a business using price earning ratio, the formula to use, the value will then be equal to PE ratio multiplied by earnings. This is total value. If I want to determine total market value of the company, this is the formula that you are supposed to use. Price earning ratio multiplied by earnings. But if it's an unquoted company that you want to value, it will be the adjusted PE ratio multiplied by earnings. So if you want to determine value per share, it will be price earning ratio multiplied by earnings per share. Okay, value per share is equal to price earning ratio multiplied by earnings per share. Okay, now you see, it is not as simple as it is. On the day of your exam, if examiner wants you to use price earning ratio, examiner will never give to you direct earnings. You are going to you are going to sweat for you to be able to get your correct earning. You are going to use revised or adjusted earnings because, you know, in practice, companies carry out some accounting shenanigans or accounting, creative accounting, all right, for them to be able to get their earnings. We call it earnings management. Depending on the goals that the company wants to achieve, they can tweak their income or their earnings for the purpose of achieving a particular goal. All right. So as a result of that, on the day of your exam, you may need to carry out some adjustment on your, in fact, in most cases, you are going to make an adjustment to your earnings and how you are going to interpret the scenario in the question to get the correct earnings. That's only where you have issue. All right. It would have been very straightforward to just say, okay, go to the question, go and pick earnings, then come and multiply with profit, price earning ratio, and you are good to go. It's not as straightforward as that. So examiner will go and hide for you. They will wait for you under the earnings. All right. Examiner can tell you that, okay, the inventory is overvalued in 2024. Now you are in 2005. So they will tell you that the inventory is overvalued by 1 million naira. So you should know when you overvalue your inventory, it means that your direct cost will go up. If direct cost, revenue minus direct cost will give you gross profit. So if you overvalue your inventory, it means that your gross profit will be low. If your gross profit is low, your tax will also be low. That's the implication. So if you have overvalued your inventory, then you need to go and make adjustments. All right. So examiner can also tell you that, okay, you increase your director's remuneration. All right. The director's remuneration was, in order to reduce tax liability, the director's remuneration was increased, okay, beyond the normal what is supposed to account for. So when that happens, then you need to make an adjustment. So there's likelihood for you to carry out prospective adjustments on your earnings on the day of your exam. So it's not as straightforward. Where you are going to have issue is how to interpret the scenario to get your adjusted earnings. So watch out for that. When we get to live question, I will buttress on that also. So that's basically how to value a business using the price earning ratio. So let's talk about, I think I'm taking too much time with this. So let's move to another one, which is dividend yield. Let's talk about dividend yield. Okay, dividend yield. Basis. How do you value a business using dividend yield basis? First thing first, you need to know what is dividend yield. You know, when we did cost of capital, we calculated cost of equity, right? We calculated cost of equity. Cost of equity is the same thing as dividend yield. Okay, it's the same thing as dividend yield. Therefore, what is dividend yield? Dividend yield is the ratio of dividend to ex-div share price. Okay, you can say dividend yield represent the ratio, okay, represent the ratio of dividend to share price. All right. You remember when we calculated cost of equity. So like I said, KE is the same thing as dividend yield, which is computed as dividend divided by share price multiplied by 100 over 1. So the ratio of dividend to share price is your cost of equity or dividend yield. So if you are now asked to determine the market value of a company's share, market value of equity using the dividend yield based or using the determine the market value of a company using dividend yield, then the market value of a company represents the present value of future cash flows discounted at the dividend yield or rate of return on equity. All right. So let me put it down for you. The market value, the market value of a company using dividend yield, okay, using dividend yield represents the present value of future cash flows, present value of future cash flows. What is the future cash flow? Dividend. Dividend is what the company will pay to the shareholders. So dividend is the future cash flow. Discounted at the discounted as the cost of equity or dividend yield or rate of return on equity. Okay, so that's what you need to do. To determine the market value of a company, so all you need to do is to divide dividend by the dividend yield, okay? So it is calculated as the ratio. Let me put it down for you. The market value is calculated as the ratio of dividend to dividend yield. Or cost of equity, ratio of dividend to dividend yield, depending on whether or not there is growth. There is growth in dividend payments. So we did this under cost of capital. I discussed this with you, and I also gave you a formula that you can use. And I mentioned that when we get to valuation, that's when we are going to be using this formula. All right. There is growth in dividend payments. So there are two different formulas you can use because of time. Let's move faster. So there are two different formulas that you can use to calculate market value of the company using dividend yield. You are given growth rates or growth is not given. So where there is growth in dividend, okay? So where there is growth in dividend payments, then in that case, market value of equity will be calculated as dividend because there is growth. So dividend multiplied by 1 plus the growth rate. All right. This assumes that dividend will grow at a steady rate for the foreseeable future. All right. Dividend will grow at a steady rate for the foreseeable future once you are given the growth rate. So divided by dividend yield, okay? Divided by dividend yield. So now I said this dividend yield may be given to you. It can also not be given to you. If it is not given to you, just go ahead and calculate cost of equity. And I said dividend yield is the same thing as cost of equity. So, all right. So once you do this, it will give you the market value. Your dividend yield is the same thing as a KE, that is cost of equity. Okay. Now, this is Sorry, there's one more thing here. Let me even use, should I even use, maybe I should use a letter. Okay, let me just use one. So minus the growth rate, all right? Minus the growth rate. Remember, there is growth. You know, your cost of equity, for example, cost of equity or dividend yield, where there's growth, is given as current dividend multiplied by 1 plus the growth rate, okay, divided by the ex-div share price, Abi. Still remember, ex-div share price, then plus the growth rate multiplied by 100%. So in case you still remember this formula, you multiply with 100%. All right. So that is that. Now, from this formula, from this cost of equity formula, your denominator is the market value that you want to calculate. All you need to do is to just cross multiply. All you need to do is to cross multiply to get your market value. All right. So this is the formula to use to value a business using dividend yield basis. Now, if there is no growth in dividend payments, number B, where there is no growth in dividend, where there is no growth in dividend payments, then in this case, the market value of equity, market value will then be equal to dividend divided by dividend yield, or cost of equity. Again, you recall when we did cost of capital under cost of equity, where there is no growth, we said cost of equity is calculated as dividend, the current dividend, divided by share price, multiplied by 100 over 1. This is the cost of formula for calculating cost of equity where there is no growth. All right. So all we did here is to just cross multiply. To now get the market value, all you need to do is to just cross multiply or cross multiply. All right. So it means that the ratio of dividend to cost of equity or dividend yield will represent the market value of equity. All right. So that is that. Let's move to the next one, which is any yield basis. Again, please, if you have any question, always raise your hand. I will answer you. So let's go to earnings yield. Basis. All right. The earnings yield basis is closely related to dividend yield. All right. Any yield is the ratio or represents the ratio of earnings to share price. So instead of using dividend, you are using earnings. You know, earnings is the same thing as profit after tax, right? So instead of you to use dividend, you are using earnings. Yes, somebody is sending a message. Amusa Mustafa, hello. Is there a difference between earnings per share and dividend? Yes, now. There are different parts of see, you know, in the statement of in the income statements of a company, the top line item is your revenue. From your revenue, you deduct direct costs. You have gross profits. From the gross profits, you less all the operating expenses. All right. Then you have profit before interest and tax. Immediately after your EBIT or any before interest and tax, you are supposed to pay interest expense. You pay interest from the loan that you borrow as a company. Then you are going to have profit before tax. Then you pay tax. Then you have profit after tax. That profit after tax, first thing first, you need to pay preference dividend. If the company finances operation with preference share, you need to pay preference dividend. Then after you have deducted preference dividend from the profit after tax, you are going to have profits available for distribution to owners of the business. From that profit available for distribution to owners, you need to pay dividend. All right, you need to pay ordinary dividend to the shareholders. When you pay ordinary dividend, whatever you have thereafter will then become retained earnings. So that's Mustafa. That's the way it works. Okay. So earnings and dividend are not the same. So it is from earnings that you are going to pay dividend. Earnings will always be greater than the dividend. All right. I believe that is clear, Mustafa. Okay. So let's move on. So I said earnings yields represent the ratio of earnings to share price. Therefore, the value of a business or the market value of a company using earnings yield is the present value of future cash flows. What are the future cash flows? The future cash flow is earnings, the profit after tax that the company will earn. Discounted as the earnings yield. Discounted at the earning yield or return or rate of return. Company's rate of return. Okay. Let me faster. The valuation, the market value or the valuation of a business. The valuation of a business using the earnings yield is calculated as the ratio of earnings to ratio of earnings to earnings yield or rate of return. Okay, depending on whether earnings will grow, depending on whether or not there is growth in earnings. Okay, so when you want to determine market value of a company using earnings yield, if in the question you are told that earnings will grow by a specific percentage, where there is growth in earnings, then market value will then be equal to earnings multiplied by 1 plus the growth rate divided by earnings yield. Anthony, why are you writing on my screen? Tony, take it out. you're writing jaga jaga on my on my screen, like the children will say. You're writing jaga jaga. Look at the way you're defacing my screen.
I'm sorry, it's a mistake.
It's okay. I understand. You can't do it intentionally. All right.
Daddy, why you
So divided by any yield or rate of return, okay, minus the growth. Let me just minus the growth, minus the growth rate. So this will give you the market value. All right, this will give you the market value of the company where there is growth. Where there is no growth, number B, where there is no growth in earnings, then market value will then be the ratio of market value will be the ratio of earnings divided by earnings yield. Okay, that's that. This is not common. In ICAN, earnings yield is not common. What is common is price earning ratio under income based approach. What is common is price earning ratio as well as dividend yield. Those are the two common method of valuation in ICAN. All right. But again, you can see earnings yield is similar to dividend yield. All right. The only thing is just that you are changing, instead of dividend, you are using earnings. That's all. All right. So let's move on. Now, well, so far we have discussed asset-based approach, income-based approach. Let's talk about cash flow-based approach. Okay. Cash flow-based approach. Let me stop sharing and share again, whether this writing will disappear. Just 1 minute. Let me share. Okay, it's gone. All right. So cash flow based, discounted cash flow based approach. Now, the discounted cash flow based approach is the most sophisticated method of valuation. It involves a lot of assumptions. In fact, even in practice, a whole lot of assumption will going into that. And it's not all companies that can be valued using the discounted cash flow basis, especially for all the banks. For our banks, for example, the GT, the Zenith, the Asset, the UBA, the whatever the name of the banks that we have in Nigeria, if you want to determine the value of each of the bank, most in practice we don't use cash flow. Rather, we use dividend because it is believed that most of the banks they pay dividend. So dividend yield basis or discounted uh, dividend model is more straightforward and faster to use than the cash flow basis, because a whole lot of things will go into your cash flows for you to determine the cash flow of the company, because you will need to bring into bear the country risk. The country risk can come in any form. You can have market risk, you can have inflation risk, currency risk, political risk, regulatory risk. So a whole lot of things comes. The country risk are all those, they are the potential risk that may affect, that are embedded in a particular in a particular country. Okay, so in a country can have political risk. When you have political unrest, or for example, unstable government, then that's a risk for an investor. So if there's a regulatory like what is currently happening in the banking sector in Nigeria, all right, right now according to Apex Bank, I think about 11 or 14 of them have met up with the threshold, the recapitalization threshold. All right. If you're an investor and you don't have that, you don't meet up with the regulatory demand, that means you cannot operate in the industry. That's a risk, right? So there could be any market, like there could be any economic risk, like inflation. So if the inflation in the country is high, certainly the interest rate you are going to pay for any loan that you want to borrow will also be high because they are intertwined, they are interrelated. There's no way inflation will surely impact the interest rates. Okay, so this all put all of this together is what is called a country risk. So when you are determining your cash flows, when you are estimating your cash flow, you need to bring to bear all those risks that I mentioned earlier. You need to incorporate them into your cash flow for you to have a realistic value. So it takes time for to value a business when you are using the discounted cash flow method. And analysts will usually they have to bring to bear their professional judgment relating to based on their understanding of the business, the company, the industry, and the to political, I mean economic environment. So many things will be brought to bear in practice. But in theory, what goes behind, I mean, what is behind generating those cash flow? There are a lot of them, but in theory, we ignore them. The focus is that, okay, the examiner will just give me the cash flow. It's more than that in practice. So banks usually they don't use discounted cash flow for their to value to value a bank. Rather, they prefer to use a discounted dividend model because almost every bank pay dividend. Therefore, that one is very straightforward. Just go to the stock exchange. If the bank is quoted on the stock exchange, go to the stock exchange. You are going to see you're going to see the information there about the company. So what is traded, what the current information, you will see it there. So you pick those values. You can then go to the audited financial statement of the company. You'll be able to see some other information that you are looking for to carry out your valuation in practice. So, but in any case, let's because of time. Now, when you want to value a business using discounted cash flow based approach, you are first thing first, you need to calculate the free cash flow. All right. You need to calculate free cash flow. And then free cash flow is, okay, before I go to definition of free cash flow. So after you have determined your free cash flow, you then need to discount the, the free cash flow at the appropriate cost of capital. So this, to now discount it will depend on the scenario you have in the question, right? It depends on the business transaction or business combination. So I'm going to be demonstrating for you what you are going to do under each scenario so that on the day of your exam, when you just look at the scenario and it follows any of the method I've given to you, you will know that this is the procedure I'm supposed to follow to carry out my evaluation. All right. But first thing first, let's talk about free cash flow. Now, like I said, the discounted cash flow based approach is a valuation method. Let me put it down. This is a valuation method that relies heavily. This is a valuation method that relies heavily on the use of free cash flow. That relies on the use of free cash flow in determining or in valuing a business, in valuing a business. Okay. For this purpose, free cash flow represents the cash flow that is available for distribution. Let me put it down. For this purpose, free cash flow in brackets FCF, free cash flow represents the cash flow that is available. Let me write it. That is available for distribution to providers of capital. To providers of capital, including debt holders and equity holders. Okay. After taking into consideration or after adjusting for or after paying or after deducting, let me put it that way. After deducting all operating expenses, and capital expenditure. Okay. Now, when you talk about free cash flows, the free cash flow is used for valuation because the free cash flow is the real cash flow, which is the economic cash flow. Economic cash is different from accounting profits. Accounting profits has a lot of earnings management that are embedded in it, and therefore it's not realistic. A company may be profitable, but the company may not have the cash available, right? So your profit that is showing in your the profit that is shown in your income statement may be different from the cash flow that you have. All right, because there are so many accounting methods that you are going to consider when you are preparing your income statement, but the cash flow is different. So cash flow will show you the receipts and payments. It will show the receipt and payment of cash within a particular period. So cash flow is not the same thing as accounting profit. And that's why when you are carrying out the value of a business or of a company, or you want to determine enterprise value, you don't use accounting profit. You don't use accounting profit. Rather, you have to use the free cash flow. Okay, so this free cash flow is available for distribution to owners of the business as well as the debt holders. Like I mentioned, that was one of you asked me a question earlier on. I think it was Mustafa Amusa. He was asking if earnings per share and dividend are the same, and I explained they are not the same. Now, in the income statement of a company, the top line item is the revenue. Revenue is the top line item. After revenue, the bottom line item is your earnings or your profits or your net income. That's your bottom line, right? So what we are saying is that from the revenue of the company, you need to first of all pay for inventory. All right, you are going to need inventory for you to sell, to generate your sales. So all those expenses that the company will incur to generate the revenue, you are going to deduct it. Then you have your gross profit. After that, from your gross profits, you then deduct the operating expenses, including marketing expenses, administrative expenses, any expenses that the company will incur to run the business. You need to deduct it. Then you now have profit before interest and tax. So from that profit before interest and tax, we now said, okay, in arriving at your profit before interest and tax, you have adjusted for depreciation, you have adjusted for amortization, you have making provision for your bad debts, right? So all those things, all those depreciation, amortization, provision for bad debt, they are not cash flow, and you have included it in your expenses. Therefore, you need to take it out. You need to add it back. You take it out from your for your profit before interest and tax, and then you add it back. So what we are saying is that because they are non-cash items, so you need to add it back. I want to determine the cash flow. I need only the cash flow. I don't need your accounting profit. So for me to be able to get the intrinsic value of the business, then you have to consider, you have to use the free cash flow. So after the free cash flow, then I need to consider in the future, I may need to incur, I may need to, as a company, maybe I want to incur capital expenditure on a non-current asset. Maybe I want to buy motor vehicle, plant and equipment, whatever it is, the capital expenditure that I want to incur. Then I need to consider it. I need to deduct it from the whatever I have thereafter. So then again, from the profit before interest and tax, I will need to pay tax because again, government authority, they will come after you. You need to settle the government. So I need to pay my tax. So once I pay my tax, I've adjusted for capital expenditure. Not only that, I also need to consider changes in working capital because it is possible in the next 1 year, 2 years, 3 years, 5 years, I'm going to need working capital. Therefore, I need to adjust for working capital. Is my working capital increasing or my working capital will reduce? Whatever the case may be, I will adjust for changes in working capital. I'll make that adjustment on whatever I have thereafter. So after you have considered all relevant expenses, all right, whatever that is left for you is the free cash flow. So that free cash flow is available for distribution to the providers of capital. Providers of capital are those investors that have contributed their money to finance the operation of the business, like the debt holders, the bond holders, okay, the debenture holders, all right, the shareholders. They have contributed their money to finance the operation of the business. Therefore, what is left thereafter is your cash flow. So those cash flow available for distribution will be paid to providers of capital. So that is what we are saying here. That is what we are saying here. So using free cash flow, it is the cash flow available for distribution to suppliers of funds. All right. Now, there are two types of free cash flow. Okay, let's write it down. Types of free cash flow. I think I'm talking too much. By now, I should have finished all the concepts. Types of free cash flow. All right.
That's all cool. Let's get the point, so quick.
Yeah. Okay, Emmanuel, you are the one. You know. So,
Sir?
no worries. Types of free cash flow. There are two types of free cash flow. One is free cash flow to the firm. All right. We have free cash flow to the firm, denoted as FCFF. Then two, we have free cash flow to equity. Free cash flow to equity, which is FCFE. Okay, free cash flow to equity. Now, what do you mean by free cash flow to the firm? The free cash flow to the firm are the cash flow available for distribution to debt holders and equity holders. It is used to determine the corporate value or enterprise value. I'll put it down for you. The free cash flow to the firm is the cash flow available for distribution, available for distribution to the providers of capital. Okay, it is used for determining, it is used for determining the corporate value, for determining corporate or enterprise value. You can call it corporate or enterprise value. Okay. Now, how do you then calculate free cash flow to the firm? There's a format. You recall when we had capital budgeting, I told you that we are going to skip free cash flow because over 90% of your calculation on that day under valuation will be based on free cash flow. And I told you then that when we get to valuation, I will show you how to calculate free cash flow. Therefore, whenever you want to calculate free cash flow to the firm, calculating free cash flow to the firm, depending on the information available, this is the format. Depending on the information available, if in the question you are given profit before interest and tax, if you are given profit before interest and tax, let me say my figures are in million. So if you are given profit before interest and tax, then you go to the question and pick the profit before interest and tax, come and post it. Remember, we said that free cash flow to the firm represent the cash flow available for distribution to providers of capital. So what this simply means is that when you are calculating your free cash flow to the firm, anything that has to do with debt holders, anything that has to do with equity holders, you are going to ignore it. You know, the debt holders, you are going to pay the debt holders interest. You are going to pay dividend to the ordinary shareholders. So you are going to pay part of the loan that you have borrowed. It is also possible that the company might have borrowed another entity a loan, and those entities are now paying back the loan. So anything that has to do with the shareholders as well as the debt holders, you have to ignore it when you are calculating your free cash flow to the firm, because what you want to calculate, the free cash flow to the firm that you want to calculate, is meant for the providers of capital. So in this case, we are less concerned with preference shareholder. Our focus is on debt holders and equity holders. Okay, so after profit before interest and tax, I need to pay tax. I need to pay tax. So to get the tax, it will be profits before interest and tax multiplied by the company tax rate. All right, multiplied by the company tax rate. Less. All right. Now, if I don't want to do it this way, I can just say profit before interest and tax multiplied by 1 minus tax. And we are still saying the same thing. All right. But to make it explicit, let me just write it this way. Now, after I've adjusted for tax, then I need to add back non-cash item. Again, when this profit before interest and tax was determined in the income statement, the company has already included depreciation. The company included amortization and provisions. So because those items are not cash flow, therefore you need to add it back. So I will then come here, add back non-cash item like depreciation or amortization or even provision. All right, you add it back. Then after this, we need to consider changes in working capital. It is possible that the company may want to purchase additional inventory. So when you do that, your cash will go out. So once your cash flow is going out, that means you are spending money. Therefore, you consider changes in working capital. Changes in working capital. And you know that working capital is current asset minus current liability. Okay, let me put it down for you. After this capital, so let me just use it. Notes. We have done this. I'm also repeating it now. Notes. Working capital equal to current assets minus current liability. Okay, so if your working capital increases, If working capital increases, it means that the company is spending more money. So cash has gone out. So if cash has gone out, then you put it in brackets. Okay. So if working capital increases, so you deduct, put it in brackets. But if working capital decreases, if working capital decreases, you had, okay, you had it. So that is what you are going to do. Where you have, when I say changes in working capital, so it could be positive or negative. So if the company incur additional working capital, you put it in bracket because cash has gone out. If the company receive cash from the debtors, for example, that means more cash has come in, your working capital has reduced. So in that case, it's a positive. All right. So once your working capital reduces, it's a positive. Your working capital increases, that means the company is spending more money. It's a cash outflow. Then after this, you also need to consider capital expenditure. So the company may want to incur capital expenditure on non-current assets. So when you do this, cash is going out. It's a cash outflow. So at the end of the day, you then determine your free cash flow to the firm. This is the free cash flow to the firm. So this free cash flow to the firm will be distributed to debt holders and equity holders. All right. Those are the two people that will benefit from this. And not only that, it is also possible the company may want to carry out expansion. Okay, may want to carry out expansion. So you can use part of the free cash flow to carry out the expansion. All right. So the company may want to pay dividend to the ordinary shareholders. Then you use your free cash flow to the firm to do it. The company may want to pay the loan that it has borrowed. You use the free cash flow to the firm to do that. So many things you can use your free cash flow to the firm to do. All right. So this is how to calculate free cash flow to the firm. But what if in the question you are not given profit before interest and tax? You are only given profit after tax. How do you then calculate free cash flow to the firm? Yes, somebody is sending a message. Let me check. Sir, please can you re-explain the positive and negative working capital? That's Ijoma. This is what I'm saying. When you are calculating your free cash flow to the firm, you are supposed to account for changes in working capital. If your working capital increases, it means that you have spent more money on your working capital. Your cash is going out. You are spending money. If you are spending money, it will be in bracket. That's cash outflow. If your working capital reduces, that means more cash has come in. It's a positive. So that's what I mean by that. When you are calculating your free cash flow, once your working capital increases, that means cash has gone out. It's a cash outflow. So you need to put it in brackets. You need to put it in brackets. But if if more cash has come in, if your working capital decreases, you need to add it. It's a positive. So you add it. All right. So that's what I mean by that. Let's say, for example, we have between 2023 and then 2024, for example, you are given inventory. Inventory in 2023 was 1,000. In 2024, 1,200. You also have receivable. You have receivable. In 2023, receivable was 1,500. In 2024, receivable was 1,000, 1,100, for example. So if I now want to determine, IJ, hope you are listening. If I now want to determine
Yes, sir.
when I now want to determine changes in working capital, between 2023 and 2024, what has happened? I want to know what are the changes that have taken place. In 2023, we were having inventory of 1,000. In 2024, it has increased to 1,200. That means additional cash has gone out. The company has spent more money in inventory between 2023 and 2024 by 200. So this 200 is a cash outflow. You put it in brackets. Now, receivables in 2023 was 1,500. In 2024, receivables has reduced to 1,100. That means there is a plus, more cash. The company has received part of the loan, part of the debts owed by the debtors. So difference of 400. So this 400 is positive because my receivables has reduced. So if your receivable reduced, it's a plus. Then at the end of the day, I will then find the net cash flows, the net working capital. In this case, 200 minus 400, this is positive 200. So my changes in working capital, I have a positive working capital. Between the 2 years, I have a positive working capital. In this case, it will be a plus. I will add it. But if the reverse is the case, if, for example, the net working capital I have is in negative, I'm supposed to deduct it. I'll put it in brackets. I hope it is clear now, IJ.
Yes, it's very clear. Thank you very much.
You are welcome. So, like I was trying to say, let's say, for example, hey.
Sorry.
No, I'm just looking at the time. I have another class by 12:30. Okay. Okay. Yeah. So let me do this one and I will stop there. We'll continue next time. Now, let's say, for example, I want to determine free cash flow to the firm, and then I don't have profits before interest and tax in the question. I'm only given profit after tax. So if you are given profit after tax, how do you then calculate free cash flow to the firm? So let me show you the format. Alternatively, okay, free cash flow, calculating free cash flow to the firm where profit after tax is given. If you are given profit after tax, then in this case, my free cash flow to the firm will then be equal to profit after tax. Whatever it is, just go and pick the profit after tax as given to you. You come and post it here. Okay? Now, before arriving at this profit after tax, you have deducted interest expense, right? You have deducted taxation. You have deducted depreciation. You have considered all those changes in whatever it is. So, because we are given profit after tax in the question, you need to add back the interest that you have deducted in arriving at the PAT. Therefore, I would then say net interest expense. To get the net interest expense, you go to the question, what is the interest given to you? What's the interest expense given to you? You then multiply the interest with 1. You had it. You have to return it. We've already deducted taxation. There's no need for us to consider taxation again because before you arrive at profit after tax, you have deducted taxation. So you don't need to consider tax again. The only thing you need to do now is to add back the non-cash item like depreciation, amortization, or provisions. Add it back. Okay? Not only that, after this, you also consider changes in working capital. If your working capital increases, you less. If your working capital reduces, you add. Then you can consider capital expenditure. Okay? So this will give us This is cash outflow. Then when you do this, this is another way of calculating free cash flow to the firm. Free cash flow to the firm. All right. So, I would have loved to continue. I would have loved to continue, but so in our next class, we are going to do free cash flow to the firm. Remember, I told you there are two types of free cash flow. We have discussed one. We have discussed free cash flow to the firm. Then we also have free cash flow to equity. All right, let me put it down so that we remember. So we are starting from free cash flow to equity in our next class. Okay, free cash flow to equity. Let me just put it down. The free cash flow to equity is the cash flow available for distribution to shareholders or equity holders. This is the cash flows. This is the cash flow available for distribution to shareholders or equity holders after deducting debts or after deducting the cash flow available for debt holders. Okay, just after deducting the debts value or whatever. So that is that. Now, the free cash flow to equity is used for valuing equity. The free cash flow to equity is used for valuing equity or determining equity value. It's used for determining equity value. You also use the free cash flow to equity to pay dividend. All right. But again, like I said, this is where we are going to stop. In our next class, by the grace of God, we continue from here. All right, we continue from here. I will show you, I will give you the formats, 3 different formats that you can use to calculate free cash flow to equity. And then begin to explain what are the scenarios, for valuation using the discounted cash flow method. All right. So I will give you scenario 1, scenario 2, scenario 3. Under each scenario, what are you supposed to do? What are you supposed to look out for in a question? I will be telling you in our next class. Then certainly in our next class we'll begin the calculations. Once again, I want to say thank you to every one of you for making time to join the class today. For the online students, we are meeting on Tuesday again. Was it Tuesday or Monday? Yeah, we are meeting on Monday. All right. So I still have one more question to solve. We have additional scope under risk and uncertainty, which is decision tree. We've not done that. So once I'm done with decision tree, then I will continue from where we stopped today. All right, but for the VI students, of course, we are going to continue with the free cash flow to equity then. So that will be that. So thank you once again, everyone. Bye-bye.